This is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, September 17th, 2024. It's 9:37 a.m. Eastern Time as I'm starting the video, and I wanted to get one out, share my thoughts and everything that's happened since really yesterday. It's not a lot, but probably the most notable thing is that the probabilities now of a 50 basis point cut have increased even further. Now we have a 2/3 chance, 65% as of right now, with a 1/3 chance of only a 25 basis point cut. So that is a material change from a week ago. The odds had been favoring the 25 basis point cut all along up till last week, where we started to get close to even, and you can see this is pulled ahead. So now, the Fed fund futures are almost always right. Especially on the big ones, I haven't seen. Now, this is not a runaway, and all I can tell you guys is the market will throw a hissy fit if it only gets this. All right, if it gets this. The $1 million question, I address it. There's articles about it and everything. Hey, what does the Fed know? Will it be a negative reaction? I'm going to just guess, and I'm also going to tell you I'm not going to bet heavy going into this thing. I'm going to show you where we might go either between now and then or more likely afterwards. So here's the way it is right now. The futures, the probability favors this 50 basis point cut, right? And my guess is, and this is just a guess, I'm not going to bet it heavy because I don't have the strongest convictions, but you'll see a positive market reaction from that. And I'm going to get to the charts in a second. And this kind of finally fits one little piece of a puzzle that I've had going back since June when I gave you my market top targets that didn't fit just right. And I'm going to get to that in 1 second. So I wanted to mention that's where we're at with the probabilities now, the rate cut. And let's go to, let me just start out here. So if you recall, back on June 26th, I laid out the final market top ranges. They were relatively tight boxes, predicting where the market would peak out at, both the S&P 500 and NASDAQ 100. The NASDAQ 100, as you know, and I've pointed out several times, came within 0.5% and almost a perfect tag on my NQ futures. I was calling for I had both the ranges and then the ideal market tops. In QQQ, my ideal market top would have got us closer to the right to the 511.74, the top of it, or thereabouts. Because that would have, if you can see on this chart, on the video, hopefully you can, I had a large part of these, both the projection before we even got to the top where it would end had to do with Fibonacci, both Fibonacci price projections, which look forward to project to where you might be going based on previous moves in the market, and then Fibonacci retracement. So looking ahead, back here it was late June, saying we'd go in this range and then top and then go down and hit these targets. Remember, we've already hit T2. You could stop trading today and you beat the market for the year by just swinging this down, reversing here, gaming that, and even gaming these last two zigs and zags. However, this was and still is and remains a market top. Now, you've probably heard this before. Market tops are often a process, not an event. It depends. There are sometimes, quite often, a single top. But, an event means just like a market bottom here. This was an event, right? You pounded out a bottom, right? The S&P peaked back in October of 2022. And that was a distinct low where the NASDAQ 100 effectively double tested that level. So it took a while there basing. And this was the bigger base, and then it broke out of that. So there was the bottoming process, right? And so I'm going to get to the S&P. So what we had is again a virtual perfect tag, and I wholeheartely maintain these market tops right now, especially in what I've been trading and still am trading. I'm trading the NASDAQ 100 is my primary index that I'm focused on and been trading and will continue to trade. Although, as I said, I suspect the next leg down, the S&P 500 will not underperform it as much. In other words, it will probably fall closer to the drop in the NASDAQ 100. Remember, this first leg down right here was a 16% drop in the NASDAQ 100 and just under less than a 10% drop in the S&P 500, as predicted, would fall less. Now, when the financials break, and they've already given me the sell signal, they hit that first benefit of the doubt support. I'm going to get to those in a second. I think we'll see the S&P fall. Again, not as much, but closer to what the NASDAQ 100 falls would be, again, my guess. So to reiterate, and again, I always say the charts are dynamic and so is my analysis, but as now nothing changed, and I believe that has marked the top, will mark the top, and I'm not expecting that another double top in the NASDAQ. However, I could see a little more upside. Let me get to the charts here. We're just now, this is that downtrend line on the 60-minute chart. So what you have right now is, and again, this is just micro analysis from a fundamental perspective. You have, and again, just today's report, a little Goldilocks scenario for the market. You had retail sales. They were looking at expecting a drop of 0.3%, came in plus 0.1. So you have a Goldilocks scenario if the Fed fund futures hold. That's why I said we get 50 basis points. Then you have the best of the bullish case. Again, not to over extrapolate here, because you do have the trend of unemployment softening. That's what's going to bake in. Or if we get a 50 basis point cut, that's what Powell's going to certainly be talking about, citing that as a primary reason, or one of, if not the. And however, when you have retail sales up, for those of you not familiar, the consumer spending, which retail sales is part of it, consumer spending accounts for over 2/3 of GDP, gross domestic product. That's pretty much, let's call it the earnings of the U.S. government, if you want to, for lack of a better term. And so as much as we blow on military and Social Security and everything else, infrastructure from the federal government, consumer spending by far and wide rules the roost. And so that you have that there. You have, retail sales came in and blew away or handsomely beat expectations, which we're calling for a drop today. You're going to get some giddiness there. And again, rightfully so, based on that one report. Remember, if you're using economic data, fundamental data, you need to plot trends, and there's going to be these aberrations. But let's just take that for what it is. So remember, the way I position isn't for nothing. I don't care if that retail sales doesn't even slightly deviate my longer term outlook fundamentally, or call for a recession, or where the market's going, but near term it could. So first things first, we're slightly above. I think you can see it ever so slightly above the downtrend line. This is a 60-minute chart. And that's the same trend line on the daily chart, by the way. So if I go to a daily chart, and it's more significant, we're there. But take it for what it is. It's a breakout now. I have divergence, and this is really, it's what I call, if you followed me for a while, you heard me say many times, I make up terms, but one of my terms is confirmed versus unconfirmed divergence. And I refer to is divergence, be it positive divergence or negative, like this is. This is negative divergence. Indicators making lower highs, prices making a higher high. I refer to that as unconfirmed until I get the bearish PPO crossover. So I like to see a lower peaks in the indicators. And so the PPO needs to roll up and then crossover, and that bearish crossover then effectively puts in a lower peak. So it's what I call unconfirmed divergence. It is, by everybody else's metric, it's negative divergence. That's simply when the indicators are making lower highs and prices are making higher highs, right? And so let's see how the day finishes. There's resistance right above, and again, it wouldn't surprise me. I'm going to talk on that now on the levels. So again, let me reiterate that going back to that weekly chart where those targets I gave you on June 26th, to me, it's just a matter of, and before I told you where I was really be concerned, and I'm still concerned, but I'm watching the S&P, and I'm going to tell you my favorite scenario right now, and where I may, I'll almost certainly be reducing some or even all, even today, of my NQ shorts going into the Fed meeting. Now we have a chance of a 50 basis point hike. There's a chance for that last hurrah rally or hurrah pop. And again, there's resistance right there. There's my zone. It doesn't change any of my outlook. And again, when you call for a market top, it does, if you hit that range twice, you never get below it, and then you go down to these deeper targets. We've already, again, it's already been a successful trade that was closed out, reversed along. There's been many trades, but for the bigger macro call, we take that out by a fair margin, and we take it out in the S&P, then it's just wrong, and that wasn't a top, and that's it. There's no way to spin it, even if we're up here. But as of now, that's the range, and I do not. Once again, I don't expect to go to the top of that range again. I think the top has been put in, like I said, on the NASDAQ 100 futures. As I said, we were effectively a perfect tag of that 2100-ish level I called for. We came in with a fraction of 1%, and we came in within 1.5% on QQQ. So there. Now let's go to SPY. Okay, so this chart was given back again with QQQ back here on June 26th. This is a weekly. I gave it into this form of a weekly chart, and we weren't there yet. I noted back then the previous peak was on June 20th, and the top of the range up here, the very top, which is about 580, about 583 at that point in time. When I was calling for that top, was above, was 6% above the current level, the current peak. As with the NASDAQ 100, I came up with these price targets using various metrics, including but not limited to Fibonacci projections and Fibonacci retracement levels from points that we hadn't even yet gotten to. Again, to call that topping range. And the one thing that never sat, it would have. Okay, let me just say, it would have been better or a little more perfect to have the Fibonacci levels, as I told you, on NASDAQ 100. The reason I had the top of the ranges as my preferred reversal points or topping points is because that would have allowed, and it did on NASDAQ 100, remember we already did it, my price targets, at least the majority of them, not each and every one, but most of those price targets align perfect with Fibonacci retracement levels. So as the way it stands now, this was, and we're testing it right now. We're right there. You can see this is a weekly chart. We're testing that same level. So, if we reverse here, I was right. If we go here, I was right. Again, this is a small range. This is not like calling for a, 10%, 20% variation in the top of the bottom of the range from high to low. And it would, I believe, even tighter in the NASDAQ 100. It's only less than a 6% range. So right now, that was the top that we had back there, as it was here again, and as it was right now. It's also pretty significant resistance level, as I've covered quite a bit. And so this is what I can easily see happen after the Fed cuts rates tomorrow, especially if they give a 50 basis point rate. Get that one last suck in of retail money, dumb money that buys a 50 basis point rate cut. Institutions will most likely, whether it's immediately that day, the next day, next week, start to unload positions, because it will be, in my opinion, again, for reasons I've stated many times in the past, all but locked in that a recession's on the way. The Fed historically has always moved in quarter point increments. That's been their preferred strategy always. They've only done 50 basis points in times of either outright crises, or outright or times of market stress. They've done it's unusual. We've had quite a few 50s over the years, but again, they come in those periods. So it will be a red flag to institutional investors. Main Street may cheer it, Wall Street, and again, the initial reaction might be good, and that's what trading's all about. It's near term where we're going. So all I'm saying, and I want to quantify it too, guys. It's a very, very small from where we're at now. Remember that back when I laid out the targets, the top of the range was only 6% above current levels. Right now, we're only talking about less than a 3% upside to the top of that range. And so what I did is, I think you can see it here. I'm going to draw it out for you. I know this chart's a little bit busy. These are the same targets, changed since June 26. I don't think I've tweaked anything here on the SPY, and I'm just going to show you where the fibs are. So T1, which we already hit right here, and I was also calling it down to the 200-day moving averages all along. However, they're moving targets because they have an upward sloping line and an uptrend. So I didn't have a price line there, nor could I, because they were, they change every day. And so we hit that, and again, that was the main reason for covering shorts. I was calling that back for calling for a pullback to the 200s. And that's what we got. We got the bounce, and you can see that was T1 price level. Here's T2. Here's T3 right here, and that's at the 38.2. So that one does align, but however, you have T4 right here, and you have a 50% Fibonacci retracement right in the middle of T4 and T5. I have T6 here. I do have a minor support level there. I think you can see it at 429.17. It's a potential target because it's support, but I didn't label it as such because I think when we get down there, we're probably going to have very little, if any, reaction. But that one lines up on the 61.8. But now what I've done here, and this is what I wanted to show you. So we go here, turn on this line, and let's just say, for kicks and giggles, but again, it's certainly a scenario with a decent potential or decent probability if there's a positive reaction to the Fed rate cuts tomorrow. And so what I've done is I put my Fibonacci, a second set of fibs. Remember, this is where we already topped. This is where we're at right now. So, that was if that was, top call. And again, this is a topping range. So, I'm right here, and I'm right if we go here, but I'm wrong if we go here, right? So what I did is if we get that pop, there's the top of the range, and you can see, and if you can't see it, I'm going to draw it out for you here. This is a 23.6. I just turned that color on that line. 23.6 comes in perfectly with my first target. The 38.2 comes in perfectly with my second target. And again, if you're new to the site, the way I do price targets typically, and the way I did it here, is I first identify, based on my experience in the read of the chart and support and resistance levels and scope of what a move might be. It's not simple as just looking at support and resistance levels. It's where in the cycle are you going to be when you have a market turn. Let's say the end of a bull run, beginning of a bear trend, especially a bear market. It tends to start out relatively slow, picks up steam in the middle. That's for your Elliott wavers. That's P3, the primary third wave out of a 5-wave cycle. Third wave is always the strongest, so that's where you'll see. And then I spoke to that too. We may blast through some targets if we get that going. So in other words, I'm still viewing this as a potential. But I take those Elliott wave counts with a grain of salt. I'm not a big Elliott waver, and as I say, I've played around with it in the past many times. But the wave counts are just too subjective to revision to provide enough predictive value, in my opinion. So. The crux of that holds true. And if you've ever, you can just study any bear market in the past, or even bull markets, you usually get that, if you can identify a 5-wave primary trend, you'll see that third wave is usually the most powerful. All right, back to the levels there. So I'm sorry, let me get back to that and get on track here. 50% fib coming in perfectly with T4. 38.2 coming in perfectly with T2. Like I said, the 38.2. These are key Fibonacci levels right here in purple. And then that 61.8 is coming much closer to T5 right there. And I could even put on, let's see, I'm missing the 78.6. There it is. 78.6 is down here. So that's it. I just wanted to say that is, and again, it's a tight range. So, this basically nothing's changed. It's just what has changed. Nothing's changed in my outlook. I'm sorry, guys, that sounds confusing. Nothing's changed in my outlook. I still believe this will most likely cap the bull market that started, or the bull run that started off the October 2022 lows in the S&P 500. But what has changed quite a bit in just a week's time is we went from a clearly favored chance of a quarter point hike to now a 50 basis point hike. And I would be surprised if you didn't get at least that initial knee-jerk reaction. I'm leaning that way. So I just want to say that's what it'll be. And now anything much above that starts to really chip away at things. Now, like I've been telling you for a while, should we have one more thrust up anytime soon, especially after tomorrow, after the Fed rate cut, it is guaranteed, 100% guaranteed. Unless we went up 20% in a day, and that's not going to happen. That's also guaranteed. Market can't go up 20% in a day. You're going to have negative divergence on that. So it will not at all change the technical posture, outlook, or anything else, nor will it negate these market top calls. The only thing that negates them is when we start clearly moving away from those ranges there. And then the only thing that really chips away at the longer term bearish case then, is if we start taking out these divergences as well. Okay, on the 60-minute chart, I'm going to borrow this DH here. That was the last divergent high we had there. See this yellow line right here? This is what we're at now. So on a 60-minute, we have my beloved divergent. This is my go-to swing trading time frame. I really like to see these divergences on the 60-minute time frame. That was the last divergent high there. We had a tradable drop, which we shorted. We covered there for the reasons stated on the futures. We had both NQ and ES futures right there at support at the time, where I just drew that line. And there was also gaps there. We reversed it, we gamed that, and then started, at least me personally, reshorting. And like I said, I can see, which again, I just want to reiterate to quantify, well, I already showed you was what, less than 2% or around 2% potential upside there. And this is, again, equal high. You take this line right here. Remember the other day, I told you it was, I called it almost divergent high 3. Now we have equal highs. That's all you need for divergences. If prices are making equal highs, as long as the indicators are making lower highs, that's negative divergence. So I'm going to reiterate that nothing in my outlook has changed. Nothing in the technical posture has changed. That's what it's going to take. In fact, in the fundamentals, the case has only firmed up. Again, one retail sales report coming in above expectation. I'm monitoring the retail sector. I'm monitoring the stocks. They tell me a lot more than reports that are sometimes. I don't know if retail sales is subject to revision. I can't recall. But either way, it's one report and doesn't change the bigger picture. So there it is, guys. There's the levels to watch. My outlook, which hasn't changed. It's at best. We have a little post-Fed pop and then a sell-off. Anything more than that, then I got to go back to the drawing board and reassess the charts at the time. New futures charts for you on this particular trading platform. When the futures roll, which they have now, we've rolled over. The Septembers are still trading, but they're the volume. Most traders have now rolled to the Decembers. So I have to. I made a new chart, which is nice too. It cleans out, purges out the board. So you'll see some new levels here down below, support levels. And so here's the S&P 500 futures, which have not. You can see that how they're lagging SPY. SPY and the S&P 500 index themselves are making those equal highs. But you still have these lower highs here in the futures, and more importantly, right here, this is the recent resistance level right here. You have I'm going to put a line there for you. Yeah, there should be a line right there. And so that is, as you can see, we're testing these recent highs right here. And if we pop that, there's the previous high. There's a downtrend line, which we're just inching above. But look at this, 60-minute divergence as well. As would be, again, these are the things I watch. If we go a little higher, we'll still have that divergence if we have a post-Fed pop. In fact, this is really where the divergence on the 60, and it's where I had it drawn on SPY as well. Guys, just so you know, this is the bigger divergence right here, and that if and when that gets taken out, then that's what I'll be looking at. So that would, again, a post-Fed pop or a pop today, that's what it's going to do. And then if and when we start taking out divergences here on the futures as well as the ETFs, then things start to change from a technical perspective, at least that aspect of it. All right, NASDAQ 100 futures. Again, you have to squint to see it. We're slightly above that level right now, the downtrend line. Again, this is the December now. I've rolled it so you can pause the video if you want to get some of the levels that I've added, resistance levels. And that one probably going to top because I am not looking for an equal high. In fact, if you recall, on the NASDAQ, on the S&P 500, I'm very, very much open, but it's so small. It's not even, again, it depends on your positioning. I don't think it's worth, trying to game it long on the upside, or unless you think we're going to blow right on through there. But, is it worth position to game for a 2% pop on what could be a big reversal? The NASDAQ 100 futures, you have the same downtrend line. Again, we're a hair above it. You have even better or as good, very, very good resistance here at about on this contract, the December's 1850. Remember, when the contracts roll, so do the levels, because these are exactly as the name implies, futures contracts. So they have a premium, differential in price built in based on on that. And so there's the overhead resistance levels, and there's your previous high. So somewhere in this range, I want to actually measure it for myself right now. So I said about a 2% or so move. That would be a maximum about 4%. And so I'm really, this is where escape velocity would certainly be over that level right there. There's just not much above that. That was a failed high, bearish engulfing candle. That level to me, sometimes they just take out what looks like a perfect level to just ruin a sell signal. But as I've maintained all along, I'm going off the fact that those bearish engulfing candles were reversal sticks, and they were good for a 16% drop. It just only time will tell if they're going to be good for the much bigger drop that I'm looking at. And so what I want to say is I'm open to that. That won't violate or take out the bearish engulfing candle. This is a 60-minute chart. If you don't know what I'm talking about, my apologies. I'm talking about the daily time frame on QQQ. We had the bearish engulfings on SOX, the semis, and a lot of other things. So that's what I'm talking about. And that's the area where I think it makes sense to stop out, or if you want to go long for a pop above the highs. I see QQQ lagging, and it's just like back in 2021 when the market peaked, or the NASDAQ peaked. We go back to 2021. I've covered this with you before. The tech-heavy NASDAQ with all the market leaders. Remember, that's what this is a concentrated view of the stock market, because you have a concentrated overweighting of the stocks that matter the most, the ones that move the market the most, and that's the big mega cap, $3 trillion tech companies: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta. And even though they exist as top holdings in the S&P 500, they have a much, 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 much smaller weighting on the index. So you're getting a more concentrated look on those leaders here. And so, as I said, we peaked back in mid-November. Mid-late of 2021. Clearly peaked there, and the NASDAQ 100 started moving lower, and had almost an equal high, but a lower high there in January. And when we peaked back in November of 2021, the S&P had a little more life left in it, and went on. And just last minute here, let me zoom in so you can see what I'm talking about. We popped that high. And what this was, it was the same exact thing now. You saw improvement in internals. You had other sectors, including but not limited to the financials, which has virtually almost a zero weighting in the NASDAQ 100. You had that extra last little hurrah, and it was a marginal new high. It was just like now, if we get that, it was a new high of about less than 2%. Yeah, you can see it there in my pop-up box. And then, so you can see we had additional strength and breadth improvement. Market internals were improving, and then that marked the top. So that's kind of the way I'm looking at it now, especially, and again, I'm doing this because What's changed just in the last couple days, even including today, is the odds going up on the 50 basis point cut. And I would be surprised, really be surprised not to see the market react positively to that. So for me, like I said, it's now no longer as clear to go home to ride any short positions into, especially if we're above those downtrend lines that I started the video with, and I'm starting. We're above it right now in SPY. We're above it in QQQ. So it would make sense to either tighten up stops, and again, where you put your stops if you are short, or where you go long, that's up to you. All I can tell you is stops should be commensurate with if you are going to ride this out and you want to go into the Fed meeting long or short, or the Fed announcement tomorrow, your stops should be commensurate with your price targets. If you are shorting here and you're on the, say you're in the same mindset I am, at most we're going to see a pop up to about here or so in the NASDAQ 100 a little bit. And you're targeting down here, T7, which is from where we're at today, a drop of about 45%. I mean, you could easily give yourself, you give yourself a 10% stop loss, and then you're getting a 4.5 to 1 RR, which is phenomenal. Again, I wouldn't give it even that much. I think, from my reads right, we've already peaked, and this still remains the top. We could run at 511.74 again, and 20. I think it was 21,000 on NQ, and it would still be the top. It would just be a double top. So that's it, guys. So just wanted to show you that. Go over the fact that the Fed Fund futures are clearly pricing in. It's no longer 50-50-ish. It's now 2/3 chance of a 50 basis point cut. And as such, the market's likely to rally. One more I wanted to update you, FLXLF. It's right now it's on, I gave you that level about 45.20, but I also told you that you're going to see noise. You're going to see the potential for whipsaws. They can go either way. Right now, this will probably be a whipsaw, but the market, the financials are liking this 50 basis point cut. That just drives them a lot of business if they get it, which looks like they're, odds favorite. They're going to be lending more. People are going to be lining up. That's what rate cuts are stimulative. Loan rates go down, and so they should see at least an initial surge, or the market will price that in. However, the offsetting factor is a recession. Again, be careful what you wish for. You get a 50 basis point cut. The Fed sees things that Main Street and Wall Street might not even see. It guarantees a recession is most likely coming, or they wouldn't be doing 50 basis points. And so the benefit to low interest rates is offset by demand destruction. In other words, a recession. People lose their jobs. Banks have to tighten credit standards, so you might have lower rates, but then if it's harder to get that auto loan or to get that mortgage or to get that business loan, then loan growth also dies, and banks too. So like I said, I already addressed this. Up to you if you want to be a purist. That was where the suggested stop, but I've repeatedly said in the last few days, my preference on things, if you have a swing short, core swing shorts, I give those room. My active trading account, I'm not going to give it a lot of room. I want to go into the Fed meeting with dry powder and be able to react on a pop-up. I would love to get a nice big pop-up to short. Likewise, if the market just craps out, and I'm looking at XLF, but let's go back to the market. If the market just craps out and starts going down, that would also be a objective time. And remember, nothing's changed. These recent lows, that's where I said that's where last time we went long in reverse was right there, and that's a level I said I believe we'll see the selling begin to accelerate and just cut right down through there if we get there. So this is a very objective level to add if and when these recent lows get taken out anytime, whether it's tomorrow or 2 weeks from now. Okay, I would normally wrap up and we just cover, remember, if you're only trading the markets, it's live or die by that trade. If you're only trading oil, live or die by that trade. I am a firm believer of diversification. Right now, crude's doing well. We're coming up to that 72.15 target for USO. and almost to T2. So get ready to take profits. That I'm going to keep that as my final target. 50 basis point rate cut may bring in some buyers for crude, thinking it's going to be stimulative for the economy. However, I see negative divergence forming, and so I just want to maintain that's my final target. I always sell a little shy of the actual resistance level, and I will consider this trade closed out. You want updates on it, let me know. Maximum target. Well, I still have that potential T5, but it's downtrend line. T5 was price resistance, but at this point, if you're going to let it be a runner trade's easy. I do that sometimes. I do that quite often, actually. Coming up to a level, if I think there's a decent chance we're going to take it out, what I do is as we get to 71.52, I'll raise a very tight stop just in case we happen to reverse off it. Then I maybe give a little up and didn't milk out the last little bit, but it gives me the potential to keep running up there to that target. So I just wanted to point out that's a very nice downtrend line. It's a downtrend line. I will most likely be the next trade on crude. It's going to be a short if and when we get there. So I want to just mention that one to you. Natural gas, UNG. I wanted to update that. Look at that. We're right to the top of the trading range. Remember, that's that old T3 level right there. T1 was hit here, way back here. We've had this, it's been a trade idea this year. We've made an equal low, still a divergent low. I'm going to borrow that. Let me duplicate it. I might already have it down there. Sometimes it gets cut off on the bottom. Even bigger divergent low, running up, big W bottom pattern. So this one's ready to rock if it can just pop that solidly. Again, not a little peek its head up and get shot down. There's still that uptrend line. Also, if you want to buy pullbacks too or set a stop somewhat below, remember, the stop raters, they know where these stops are. So when I say somewhat, you got to give it a little bit of room. We say better if you can, especially if you can apply a time criteria, not just a price criteria to that, where you wait for a 60-minute, 120-minute, or even a daily close below a support level. That usually helps you sidestep the stop rates. And for your futures traders, remember, this is the comparable level. We've rolled this since we started this trade. We have that divergent low, same divergent low, actually bigger. It's really one and the same. I keep drawing it out in these videos. I'll draw it there. Remember, just like UNG, the ETN, it's even bigger divergence right there. Same thing. It's that W pattern right there, potential W bottoming pattern. With just very well-defined resistance at about 246, we'll call it. Pop that, and we should be running up there. But as I like to say, resistance is resistance until unless taken out. So if you've been, if you recycled back in on this pullback, for example, and you made that quick, what is that? I'm going to move one of those lines, 15% profit or whatever it is, close to it. I'm putting that line there because I see two reactions. That's support level. Then you could certainly take profits there if you wanted. Or, like I said, raise your stops and let it run. I think this one has potential for more. And speaking of trades that are just pushing up on the resistance level, if you recall, Intel, one of my only semi I own long. I had NVIDIA long through some of this, but I'm short NVIDIA again. If you recall, I'll give you a scale and so I'll get to that next, and I'll wrap it up, maybe do an update on that PayPal. But this is that trading range. Remember, this is long-term support here, right here. That's the basis for that, with positive divergence on the monthly, weekly charts. And we still need to pop. Look at this. They keep running up to that 22 level. And so if they can pop that, we go. If the market likes what the Fed is selling and it's more than just a brief, even if it pops. And again, Intel's kind of marched to its own drumbeat lately. But I just wanted to reiterate that. So if you can call it a new buy signal, an add-on, objective add-on. If it pops and falls back solidly in the range, it's probably going to go back to the bottom. Remember, that's the MO on trading ranges. You go long at the bottom and you sell at the top. This is it, right? And so if you break out and fail, if the market takes a crap, then Intel will probably get dragged to the bottom of the range. Otherwise, that's the current target right there. And I may, if the market wants to run to new highs and takes out my the maximum target zones I started the video with, then I may add additional targets to Intel. There's others out there. I'm not going to cover each and every one. PayPal's just kind of grinding around, still up, from not much. It's, still shy of my first target. Remember, this is that trade right here. You had support level here, and then we popped 70.69 and came back in, back tested 68.61.18. So if the market holds up, this one holds up, goes to T1, T2, still looks constructive longer term. But if the market craps out, then this one probably will. So consider a stop somewhat below that recent low is what I would do. Wheat still, coming under pressure after that most recent divergent high I pointed out the other day. You can see I'll leave that there because that was a former T1 level, but I see a level right here I should highlight because it is acting as, we have a lot of reactions there, and that's right here. 514, which is a little bit below that 517 T1 level there. And then, yeah, right about here, if that level breaks, you have support around 503. Again, bigger picture, longer term, it still looks constructive. We're coming off this divergent low. We have a nice rally off that divergent low. It just put a negative divergence on the 60-minute chart and ran into our first price target. I got a little bit above there, in reverse, a little shy of T2, but that's where you're watching right now. So at this point, if you could take a shot here, I'm not so crazy about it right after the divergent high. I'd love to see that divergence taken out. PPO remain above the zero line. That would be healthy to see, and then power back up and then take out T2, and this thing should really start getting traction if it can get above T2. If it falls down here, that's still an objective long entry, as would be R1. Anything below that, I don't like it. I shouldn't say that. I may still like the longer term charts might remain constructive. As of now, like I said, I would consider a stop below there. Because if we take that 492 R1 level, means first resistance back here it was, which is now S1, R1, S1. Remember, resistance once broken, then becomes support. That would be, I think, an objective stop loss level somewhat below that 492 level, because then they'll probably run at and make a marginal new low. That's been the MO for wheat lately. Takes out the previous low, puts in a marginal new low, then it rallies, then puts in a marginal new low, then rally. But remember, this one's different. We had lower lows all along, lower highs, lower highs, and lower lows. 1, 2, 3, 4. That is the definition of a downtrend. What do we have now? 1, 2, 3 higher highs and higher lows and higher highs. And so ideally, you don't always get what you want. You remain above this previous reaction low, and then you take out that previous reaction high, and that keeps this newfound uptrend intact. All right. There's your update. Long-winded video, but covered everything I wanted to cover. Fed coming up, going to be a lot of noise, going to be a lot of whipsaws. That can be to the downside, upside. You do you, I'll do me. That to me is on swing positions. I give my stops a little more wider room. Active trading account, like I said, I'm going to manage that very tight. I'll make a decision before heading into the FOMC rate decision tomorrow, whether to be positioned on the indexes at all. Or even to be long, to play a post pop, if I want to try to milk that out as an active trader, not a swing trader. I wouldn't, again, it's not worth it, in my opinion. What I see a maximum, maybe 2% upside, 2-3% upside post FOMC pop, but we'll see. Again, these are the things I'm watching today, including but not limited to the fact we're poking our head. Really not, it's not a very impulsive breakout above those downtrend lines. We are above them. But like I said, I clearly in the last couple of days stated expect whipsaws. So you got to take any breakout or a breakdown with a grain of salt until the Fed is out of the way tomorrow. And Powell does his little dog and pony show at 2:30. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.